All right, welcome everyone, and thank you for joining us as we kick off another entry in the Retirement and Inheritance webinar series from Unchained Capital, the premier Bitcoin native financial services company. I'm Connor Dolan. I'm a director on our client solutions team, and I am here today to host as we embark on a topic that is guaranteed to be a riveting discussion: taxes. And although I say that potentially sarcastically, it is genuinely the truth, because taxes is one thing, but Bitcoin taxes, that's a whole different beast altogether. It's really interesting, and it's especially interesting when you're getting educated from the man who probably knows more about Bitcoin taxes and Bitcoin IRAs than anyone else in the country. He also happens to be our head of retirement and inheritance here at Unchained Capital, and a fan favorite on this webinar series, Mr. Jeff Vandrew. Jeff, I'm sure you woke up today ready to run through a brick wall to get to this discussion. How are you doing?
Thank you very much, Connor. I appreciate the enthusiastic intro, and it's great to be here.
Yeah, well, we are very excited to have you. Thank you in advance for your time and your insights today. Before we get going, a few housekeeping items. I certainly want to point out, as always, this webinar is going to be recorded, and a replay will be made available on our YouTube channel probably within the week. If you haven't caught our last two webinars, which were focused on an overview of the Unchained IRA, as well as the McNulty case and the impacts of that on self-directed IRAs, definitely recommend you checking those out. Also, to make sure that you don't miss any webinars in the future or any of the great educational content that our team is constantly putting out, I definitely encourage you to sign up for the Unchained Capital newsletter as well. Finally, a couple of quick notes on this webinar platform that we use. You actually have the ability to download the presentation deck directly from this platform by clicking the little box in the top right corner of the presentation window. Additionally, certainly want to point out, there is a questions box in the bottom right corner. We always make sure to leave time at the end for Q&A, and you can input any questions that you have into that questions box, as well as see the questions that others have asked and vote on the ones that you want answered most. And a quick point on the Q&A. Today's webinar is primarily focused on Bitcoin taxes more broadly. And if you have any specific questions on the Unchained IRA, we are actually going to be hosting a dedicated forum for that in the form of another webinar 2 weeks from now, focused on Unchained IRA for beginners. We will certainly try and make time at the end and answer any IRA questions, Unchained IRA questions if we have time, but there is also a dedicated forum for that now. That'll be in 2 weeks. We'd love to have you there. There will be a registration link in the chat as well. Now, with all of that out of the way, let's take a look at the agenda for today. I'm going to pass it over to Jeff here shortly, and he's going to walk through how Bitcoin is taxed currently as property in the United States. We'll then walk through acquisitions and dispositions and the difference between those. We'll talk through special circumstances and how to treat those. And we will spend some time at the end talking about IRAs more broadly and the Unchained IRA and how you can utilize this solution for tax benefits with Bitcoin in an IRA. And as I discussed at the end, we will certainly make sure to have time at the end for all of your questions in a Q&A. Now, with all of that out of the way, I will pass it over to Jeff here. As I sit here in our headquarters in Austin, thinking about the beautiful synergy between Bitcoin and Texas, I'm going to pass it over to Jeff to talk about the beautiful synergy between Bitcoin and taxes.
Thank you very much, Connor. So the first thing that, is sort of the foundational thing everyone needs to understand when we're talking about taxation of Bitcoin in the US is that Bitcoin is treated under the tax code as property and not currency. Now, what's particularly interesting about that is there's no statutory authority that says Bitcoin is property, and there's actually not even any formal regulatory authority that says Bitcoin is property. So let's parse that for a second. By statutory authority, what we're referring to is an actual section of the Internal Revenue Code, and that would have to be actually enacted by Congress. So at that level, it's not all that surprising that Congress has not gone out of its way to, address Bitcoin's tax classification. As most people know, it's kind of hard for anything to get done in Congress. Formal regulatory authority in the context of taxation refers to Treasury regulations interpreting the Internal Revenue Code. And those Treasury regulations are found within what's called the CFR, the Code of Federal Regulations. So normally what would happen in this situation is the IRS would actually issue an interpretation under the relevant section of the Internal Revenue Code stating that Bitcoin fits the definition of property and not currency. And then there would be a notice and comment period and a formal adoption process. And after that, it would make its way into the Treasury regulations. That's not how the IRS did this. The Bitcoin as property idea is solely based on their best interpretation of existing law, and they just kind of threw it out there in an IRS notice. That's notice 2014-21. An IRS notice is sort of interesting because we don't know how much actual deference that is entitled to. So when you're talking about a Treasury regulation, that has something called Chevron deference, which means that if you're a taxpayer and you want to challenge that Treasury regulation in court, the standard applied by the judge is going to be, hey, is this Treasury regulation like a completely arbitrary interpretation of the Internal Revenue Code? So it's a high bar to meet, the Chevron deference standard if you want to challenge it. When it comes to an IRS notice, which didn't have these notices, unlike a Treasury regulation, there's no notice and comment period or anything like that. It's just something that one day they just threw out into the wild. We actually don't know whether or not that's entitled to Chevron deference. So at the current time, that's probably an academic distinction because I think the notice is probably clearly correct. And what I mean by that is the way people typically use Bitcoin today is as investment property, not for everyday transactions. So I think that's probably it's so clearly correct that I don't think that you'd really have much grounds to challenge that classification in court anyway. Where this could potentially become interesting in the future is if Bitcoin over time does begin to be used more in everyday transactions, and let's say the IRS does not, affirmatively go out and revoke this notice or issue a new notice stating that now Bitcoin is currency, and a taxpayer actually wants to make that argument in court, it'll be interesting to see whether or not that Chevron deference is the bar that has to be met, or if there will be some lower bar due to the fact that, again, this is not a Treasury regulation that was adopted with a notice and comment period.
Yeah, that's really insightful. And that was actually going to be one of my questions is if we see this potential, if it were to potentially change in the future and be taxed, I guess, as you said, as currency, would that ultimately be beneficial for Bitcoin, or what would the impacts of that be? And do you see that as potentially likely to happen?
Yeah, I mean, it sort of depends. I don't think it's likely anytime in the near future. I mean, this is a long ways off. Currency taxation would the big difference would be that like small transactions, like you wouldn't have capital gains and losses. So, for instance, if you're like doing forex trading on an exchange, you have like gains and losses, right? But if you buy a bunch of euros to go to Europe on vacation, there's a de minimis standard there that says you don't have to have like a US dollar gain and loss every time you buy a muffin in Paris, right? So we would fall into that category if Bitcoin were to eventually become considered to be currency in the future, which could happen in a variety of different ways. The IRS could issue a new notice overriding the old notice. It could actually issue a Treasury regulation, which would just by on its face override the old notice. It's a higher level of authority. Or Congress could circumvent the whole thing and actually pass a statute.
Why so bearish, Jeff? I'm just kidding. You don't have to answer that one. Let's move on to the acquisition section.
Yeah. So one thing I think that most people do know about Bitcoin is the actual acquisition, if it's in the form of a purchase, is not a taxable event. So if I go to the, I was going to say an exchange, but you know what? No. If I go to the Unchained OTC trading desk, how everyone should be purchasing their Bitcoin, and I buy my Bitcoin there, I don't have a taxable event. The amount that I pay for that as part of that purchase is going to become what's called my tax basis in my coins. And that tax basis is going to become very important later on because that's the baseline figure that's going to be used in order to compute my gains and losses. On that point, keep your eyes out because we're going to have a poll coming up soon. There are various software packages out there that can help you track your tax basis when you purchase your Bitcoin. And even if you don't intend on ever selling, it's that can be an important thing to keep track of because you would want to know if you ever spent your Bitcoin in the future, right? Because as you'll see, tax basis is important in those sorts of transactions. So yeah, when that poll comes up, be sure to vote. And if you're not currently tracking your tax basis, maybe you want to look at one of those software packages and start tracking your tax basis. So another type of acquisition other than an actual purchase would be you actually receive Bitcoin in exchange for someone buying something from you. In other words, let's say I sell my car for Bitcoin, right? Or actually in this case, it's yes. It's let's say I sell my car. Well, that's not the best example here based on this. Let's say I actually own a store, so I'm in the business of buying and selling goods. I own a grocery store, and you come in and you buy a loaf of bread from me. That's a better example, and you pay in Bitcoin. So the Bitcoin that I receive, that I acquire in that case, that's ordinary business income to me that I have to pay tax on at ordinary income tax rates at the fair market value of the Bitcoin I received. The idea here is that the taxation shouldn't be any different regardless of whether I get paid in Bitcoin or dollars. So if you come into my store and you give me a $100 bill, I have $100 of ordinary income, right? If you come in and you give me $100 worth of Bitcoin, same idea. I have $100 of ordinary Bitcoin because, I have $100 of ordinary income. If my store or my business is not organized as a corporation or an entity, but I'm just receiving it as what we call in the tax code a natural person. And you might hear me use the word natural person throughout this presentation. That's a term of art in taxation. So natural person just means a human being. That sounds kind of funny, but the reason why we specify natural person is because person means more than just a human being. Under the tax code, a human being is a person, a corporation is a person, a partnership is a person. So when we want to drill down to an actual human being, we say natural person. So in the case of a natural person recipient on top of ordinary income tax, it would typically also be subject to self-employment tax. Self-employment tax is the amount of tax that, is the amount, it's my payment into Social Security and Medicare. It's equal to the amount of Social Security and Medicare taxes that would be paid if I were receiving that money as an employee, as opposed to an independent contractor or subcontractor or other type of businessman. And on that topic, in the case of an employee, if my employer pays me in Bitcoin, that is also subject to ordinary income tax at ordinary income tax rates, just like if I was paid in dollars. It is subject to FICA tax, which is my contribution to Social Security and Medicare, just as if I were paid in dollars. And it has to go on the W-2 that I receive at the end of the year, just as I were paid in dollars. And it goes on the W-2 at the fair market value in dollar terms based on the date I received it. So if I have an employment contract, let's say I have like a really great employment contract where I get paid 1 Bitcoin a month, right? I'm doing pretty well. Well, if Bitcoin is worth $50,000 in January and it's worth $40,000 in February, I got paid 1 Bitcoin a month, but it's valued at the time I actually received it. So that would end up, those two payments would end up going on my W-2 at $90,000. The amount of ordinary income that I recognize, whether I recognize it as a businessman, an independent contractor, whatever the case might be, or as an employee, the amount of ordinary income that I recognize on receipt, that becomes my tax basis in those coins that's going to become relevant going forward if I later spend those coins or otherwise dispose of them.
Right. So it doesn't matter when you actually sell. The tax basis is based off of when you got paid and the Bitcoin value at that time.
Exactly. That's exactly right. If I got paid today, and this can create some weird mismatch situations, which we're going to see later in the presentation, but like if I got paid today and one Bitcoin and Bitcoin was worth $50,000, I have $50,000 of ordinary income. If I spend that Bitcoin a month later and Bitcoin is only worth $40,000 at that point, that doesn't change the fact that I still had to recognize $50,000 worth of income on the day that I got paid.
Sure, makes sense. And a quick reminder, see a couple of questions coming through in the chat. Certainly keep them coming, but make sure to put them in the questions box in the bottom right so we can organize them, make sure we see all of the different questions coming through.
So another way that you can acquire Bitcoin that obviously people often have questions about is through mining. So acquiring Bitcoin through mining is generally treated the same way tax-wise as receiving Bitcoin in exchange for services, meaning on the day that you actually receive that block reward, you have ordinary income, right? And that ordinary income that you recognize on that day, which is based on the fair market value of Bitcoin on that day, that becomes your cost basis going forward. Now, if you're this really isn't mining has obviously over the past 10 what are we at now 14 years of Bitcoin has become a lot more professionalized than it once was. So at one point you could probably argue that like, hey, I'm mining on a casual and infrequent basis enough that it doesn't rise to the level of a trade or business, and therefore it would not be subject to self-employment tax, only to the income tax. But at this point, that's probably kind of a tough argument to make, right? Because if you're doing mining, you're not doing it halfway at this point. It's a very professionalized thing. It's not a bright line test, though. It's subjective as to whether something is done on a consistent enough basis to rise to the level of a trade or business. And one thing I just want to emphasize is regardless of whether or not it's a trade or business, it's still subject to income tax. The trade or business distinction only matters in terms of whether or not it's subject to self-employment tax. And that only matters if you're doing mining as a natural person and you're not doing it through, say, a corporation or other entity. Because if you were doing your mining through, say, a corporation, corporations don't pay self-employment tax. They just pay regular income tax. And then you would get a W-2 for your services from the corporation. And however much you were paid on your W-2, that's going to be subject not to self-employment tax, but it'll be subject to FICA. And FICA and self-employment tax are essentially the same thing. FICA is for employees. Self-employment tax is for self-employed people, but they both boil down to your contributions to Social Security and Medicare.
Right, and it's for that reason ultimately that we don't offer Bitcoin mining within the Unchained IRA. Is that correct?
Right, because if mining meets the standard of a trade or business, then in addition to all these tax consequences I just talked about, it means it creates what's called a UBIT problem within your IRA. That stands for unrelated business income tax, meaning your IRA is not tax-free anymore. You start having to pay income tax on your IRA income, which is generally not something that you want to have to do. Interestingly, it's not necessarily the case that trade or business for self-employment tax purposes means the same thing as trade or business for UBIT purposes. They are different sections of the Internal Revenue Code. However, the Treasury regulations kind of say that if it's enough of a trade or business that you'd be able to take a tax deduction for your expenses if you were doing it outside of an IRA, then it's typically subject to UBIT if you're doing it inside an IRA. As a result, I think you'd have a tough argument to make that it wasn't a trade or business, because as we all know, miners do deduct their costs against their mining income typically, such as their electricity and their equipment, those being the major costs of a miner.
Got it. Yeah, thank you. And we can certainly cover that in further detail if our audience wants to in the IRA section. Cool. So let's move on to one of my favorite sections of this presentation, which is just talking about gifting Bitcoin to others, which is something we always encourage.
Yeah. So another way you can acquire Bitcoin is obviously through a gift. One of the stories that I tell that Connor particularly likes is, when I was a kid, which was, in the Stone Age, we used to get on birthdays, it was very common that you would get paper savings bonds, right? Like your aunt would always give you some paper savings bond and you're a kid and you're like, this stinks. I don't want this. Like, here, mom, put it away in the safe deposit box for me. So like my modern twist on that when it comes to like my friends' kids or my niece and nephew is I give them Bitcoin on their birthday. I just slip a little paper wallet with a small amount of Bitcoin in a card. And, I tell their parents, of course, to sweep that paper wallet into an unchained vault once they receive it. But, you could use it if it's a lot of Bitcoin that you're giving and more than just, 25 or $50 worth, you might want to use an open dime or something like that. But, it's a neat little physical thing that you can put in a card and give to a kid as a gift. And it's kind of the modern take on on giving a savings bond. Because believe it or not, they don't actually even issue paper savings bonds anymore. That's how infrequently people are giving those as gifts. Like you can't get one if you wanted to give one as a gift, even if you wanted to. If you want to buy a savings bond, like you have to do it in your Treasury Direct account over the internet. But anyway, as I said, a bona fide gift, right? So first of all, what is a bona fide gift? Because the reason we use the word bona fide there is because there are all kinds of ways we could just like randomly say to people, oh, this is a gift, right? But it has to be an actual bona fide gift. Me saying it's a gift doesn't mean anything. So a bona fide gift is one where there is true donative intent. Typically, any sort of quid pro quo is evidence against donative intent. And then it's a barter transaction in that case, which is a totally separate, kind of deal. So with a bona fide gift, the recipient does not have a taxable event upon receipt. So if I were to give Connor a Bitcoin and it was a true bona fide gift, he would not recognize any income. The weird thing about bona fide gifts is you get what's called a carryover basis from the donor. So when you receive a gift in Bitcoin, your basis is not the fair market value on the date that you receive the Bitcoin. It is the basis that the guy that gave you the Bitcoin had in the Bitcoin. That's why it's called carryover basis. So if I gave you a gift of Bitcoin, you would actually have to like ask me what my basis in those coins are. If you're giving your niece or nephew $25 worth of Bitcoin, you're not worried about it because the basis is trivial at that point, right? And if they spend it or sell it at some point in the future, they're going to use zero basis. But if you're gifting someone a substantial amount of Bitcoin, you typically would want to, make sure that they were aware, let's say, of what their basis was in their Bitcoin. So the other thing that's important to keep in mind with a bona fide gift is the donor may need to file a gift tax return. So everybody is able to give up to $16,000 a year per recipient without having to file a gift tax return. If you go over that 16, and that 16 grand, that changes every year. It's an inflation adjusted figure. What'll happen is if you go over, let's say, that $16,000, then you have to file a gift tax return. You may not owe actual gift tax because you also have a lifetime gift tax exemption that also increases with inflation every year. It's a little below $6 million right now per person, but you still need to file the gift tax return to let the government know that you've sort of eaten away at that lifetime exemption. And once you've gone over your lifetime exemption, that's when gift tax, may actually start to kick in for you.
Yeah, and you had mentioned Open Dine previously, which is ultimately just a way to not only gift Bitcoin but hand over the private keys to someone at the same time. I'm curious, does it matter how that Bitcoin is given? For example, sending to someone's address versus actually handing them an Open Dime?
No, it doesn't matter. I mean, the transfer takes place when that other person gains dominion and control over the coins. So that could be sending the coins to an address where they have the private key, or it could be just handing them the private key, which would be the case in an Open Dime or a paper wallet, right? Either one of those things for tax purposes are equivalent.
Got it. And I think we'll talk.
I don't recommend this, but even if you were to send it to their Coinbase account where they don't have the private key, Coinbase gives them a right of withdrawal. So that still would be considered the fact that they had carryover. They would have dominion and control at that point. Or any wallet where they don't have the private key.
And I think we'll be talking about dominion and control a little bit further in this next section. So maybe
that is correct. Another way you could acquire coins in general, and this has become less of an issue for most people since 2017, thankfully, is through forks and airdrops. So you have ordinary income upon receipt of a fork or an airdrop in the amount of the fair market value of the forked coins on the date that you receive. We're going to talk about this further, as you said, dominion and control over those coins. That fair market value, which is the ordinary income that you recognize, that becomes your cost basis going forward. So dominion and control is generally held to be when you have actual ability to move the coins if you wanted to. It doesn't matter if you actually bothered to download the necessary software to move the coins. If you had the ability to do so, that's the date where this became an issue. So normally that's the fork date. If you're holding your own private keys, that would be the fork date. The exception to that would be if you're holding the coins custodially, it would be the date that the custodian actually goes and grants the coins to you. So Bitcoiners had a lot of issues with this in 2017, right? Because there was the Bcash fork. And whether you wanted your Bcash or not, you got it. And you had and on the date that the fork took place, Bcash did have a fair market value, right? It was trading on that day. So you did have income on that day, and you were supposed to, declare that income on your 2017 income tax return, right? Now, the good news is the forks that we've seen since that point have generally just been like random stuff that hasn't had a readily ascertainable fair market value. So the way most people have dealt with that is by not claiming anything at all because the coins had no fair market value on the fork date, excuse me. They were just a zero fair market value. They weren't trading. There was no way to easily dispose of them. So the fair market value out of that in that case was necessarily zero. In the case of the Bcash fork, some people did really well with that. I immediately downloaded like Electrum, whatever. There was like a version of Electrum for it, grabbed my coins and exchanged them for real Bitcoin, right? So I made out fine. Other people, particularly people that had their coins on Coinbase, had a problem because, which we're going to talk about later. Coinbase, unfortunately, did not credit them the coins until Bcash was like at its all-time high. And then when they actually tried to dispose of those coins, hopefully to exchange them for real Bitcoin, it did not go well for them because they ended up with a capital loss that they could not use to end up offsetting all of that income. So we're going to talk about that situation later in the presentation.
Perfect. Well, I know we got a lot of content here still left to go, so we can move right along to dispositions here.
Yeah, so when you dispose of Bitcoin, you have to keep in mind whether your holding period. If you've held your coins less than a year, it's a short-term capital gain, meaning you're paying taxes at ordinary income rates. If you've held your coins greater than a year, you pay tax at the long-term capital gain rate, which are favorable tax rates. Depending on the amount of your other income, that long-term capital gain might be taxed at 0, 15, 18.8, or 23.8%. So with the classic sale for US dollars, you transfer your coins onto an exchange and you swap them for dollars. The difference between the sales price and your cost basis, which is something we've been talking about throughout this presentation, how you determine your cost basis, that's the amount of your capital gain or loss. And whether that gain or loss is short-term or long-term depends on your holding period, as we discussed on the last slide. If you take your coins and you use them to make a payment for goods or services, what happens in that scenario is the sales price is it's a deemed sale, first of all, for US dollars. And the sales price is the fair market value of the goods or services that you received in exchange. So you have a capital gain or loss between that deemed sales price and your cost basis. If the underlying expense that you're using the Bitcoin to pay is a deductible business expense, the fair market value of the goods or services received is the amount that you're able to expense. If it is a payment to a subcontractor that you're making in Bitcoin in the course of your business, you have to report that payment on a 1099 NEC, just like you would if you were paying a subcontractor in US dollars.
Great. And quick reminder, we do have a couple of polls up in the bottom right corner. There's a poll box. Definitely go in there and let us know your thoughts.
Another disposition is a possibility is when you're disposing of Bitcoin that you're holding as inventory. That's a rare situation. I doubt it's going to apply to anybody here. But if you're actually in the business of buying and selling Bitcoin, like if you were operating an exchange or if you're Unchained Capital, we're in the business of buying and selling Bitcoin with our OTC desk, then Bitcoin is, instead of being treated as a capital asset to you, it's treated as inventory. And in that scenario, your gains and losses are not capital gains and losses. They're ordinary gains and losses. So what that means is as an ordinary gain, it's always subject to ordinary income rates, regardless of holding period. And as an ordinary loss, instead of the loss being limited, so one thing we haven't talked about yet is that capital losses, which is what most people experience when they sell or dispose of their Bitcoin as a loss, you can only use those against capital gain income. You can't use those against your ordinary income. The only exception is up to $3,000 of losses per year you can use against your ordinary income. But otherwise, generally speaking, capital losses can only be used to reduce your capital gains. That's not the case with ordinary losses if you're in the rare situation where Bitcoin is considered inventory in your hands. Another way that you can dispose of your Bitcoin is to charity, which is a really great way to do it because there are so many tax benefits to this beyond a normal charitable deduction that most people forget about. So if you have Bitcoin and your holding period on that Bitcoin is long-term, if you donate that Bitcoin to charity, you get a tax deduction for the full fair market value of the Bitcoin that you have sent over, not just your tax basis. That's big, right? And on top of that tax deduction, you do not have to recognize gain or loss on the disposition. Other than like a bona fide gift, this is the only other type of disposition where you don't have to recognize any sort of gain on appreciated Bitcoin when you get rid of it. Now, the recipient has to be a 501c3. And if you are gifting them over $5,000 worth of Bitcoin, you have to get what's called a qualified appraisal. You can't rely on just like a trading value. You actually have to hire a guy to he has to be an IRS qualified appraiser. That's a thing. To actually issue a formal appraisal opinion on the value of the Bitcoin that you gave. There are a variety of different what are called, they call it cryptocurrency appraisers, as you'd imagine, because a lot of people unfortunately are giving things other than Bitcoin that will do this. If you're only gifting Bitcoin and not hopefully other types of cryptocurrency, it's usually like $500 or something like that to get the appraisal. So as you can see, this is extremely favored. There's a double tax benefit here. Not only do you get the charitable deduction, but you also do not have to worry about the capital gains. So one strategy you can do, if you have low tax basis Bitcoin, you can donate that Bitcoin to charity each year and then repurchase a new Bitcoin to replace it. And now you've just effectively bumped your cost basis way up without having to deal with any adverse tax events.
And I will make a plug here. Jeff wrote a fantastic piece on our blog about charitable remainder uni trusts, also known as CRUTs or CRUTs, that I highly recommend. It's really interesting.
Yeah, we call them CRUTs. It's an ugly sounding word, but that is what they're called. Yeah, so another thing to keep in mind here with dispositions is which Bitcoin are you actually disposing of when you dispose of Bitcoin. The default rule is FIFO, meaning when you sell or otherwise dispose of a Bitcoin, you're selling or otherwise disposing of the oldest Bitcoin that you have. However, so this is very weird. IRS put out an online Q&A regarding what they call virtual currency. I wish I could tell you what level of authority an online Q of A has. You know, when we talked about Chevron deference before, I have no idea because that's a weird thing. I've been practicing tax law for like 15 years. I had never really dealt with an online Q&A as a type of authority, but it's a thing they threw out there. And you're probably in good shape if you follow it. So under IRS Online Q&A 38 and 39, specific identification is allowed in place of FIFO with correct records. The way the answers to those questions are written is that specific identification requires disposition by private key, public key, and address, or by records showing transaction information for all units of a specific virtual currency, such as Bitcoin, held in a single account, wallet, or address. What does that mean? I don't know. That's basically a lot of words that don't mean anything in terms of giving guidance in terms of how you could actually use specific identification. Specific identification means you can point to a specific Bitcoin that you sold rather than relying on FIFO. You could say, like, I'm selling this Bitcoin that I bought on this day. If you're using coin selection to dispose of a specific UTXO, that I think is like a fail-safe way to substantiate this, right? If you want to go the specific identification route. Absent doing that, I'm not exactly sure what to tell you. I wish I could give you better advice there. Talk to your tax attorney, of course, but you know, the safe route is either to stick with FIFO, or if you're going to do specific identification, use coin selection on a specific UTXO. Beyond that, like I said, I don't know. I don't have a good answer for you. You're kind of flying blind and doing your best.
Yeah, and that's a nice reminder to remind everyone on this call and on YouTube that we cannot give tax advice. Let's move on to the special circumstances.
Yeah, so we can get weird mismatch situations because of the way that Bitcoin is taxed. So let's say this is funny. So I did this presentation not that long ago, and we left the original numbers on here because they were round numbers. Bitcoin was actually only $10,000 at the time I first wrote up this presentation. It shows you how much things have changed. So let's say that you receive 1 Bitcoin for services, and at that time, 1 Bitcoin, the exchange rate is $10,000. By the time you sell that Bitcoin later that year, that Bitcoin is only worth $5,000. Well, when you file your taxes for that year, you have $10,000 of ordinary income and a $5,000 capital loss. Those do not offset each other. The capital loss can only be used against the lower taxed capital gains, not the higher taxed ordinary income. So you end up in a really negative tax situation there by doing that. Obviously, not selling would be the best way to get out of that problem. But absent that, you're in a little bit of a rough spot there. The only exception, as I mentioned before, is if you have no capital gains at all in a given year, you can use up to $3,000 of that capital loss against your ordinary income. But again, because of that $3,000 limitation, that's not going to help you that much. So the Coinbase Bcash fork debacle is a good example of how this plays out in the real world. Coinbase gave its Bitcoin holders their Bcash at basically its all-time highs. They didn't give it to them on the fork date. There were like lawsuits about whether they were going to get it at all. It was like a crazy situation. And by the time most people actually were got the Bcash credit to their account and were able to flip and switch that Bcash over to real Bitcoin, the price of Bcash had fallen significantly. The exchange of the Bcash for Bitcoin is a deemed sale of the Bcash for US dollars, followed by a deemed purchase of the Bitcoin for the US dollars. So the deemed sale part of that transaction creates a capital gain or loss. In the case of those people, capital loss. So back when this happened, I was still in private practice as a lawyer, and I had clients that were caught up in this. So they ended up with a lot of ordinary income and a large capital loss, but the capital loss couldn't offset the ordinary income. So it was kind of a lousy situation for them to be in, but there wasn't a whole lot they could do about it. So this Coinbase situation, which created a lot of tax agita for a lot of people, here's the good news. It happened in 2017. That means your tax return for 2017, if you did not file an extension, was due April 15th, 2018. If you filed an extension, the due date was October 15th, 2018. That means that the statute of limitations typically would have expired for your 2017 tax return on either April 15th, 2021 or October 15th, 2021, which means you're essentially outside the audit period for those situations. The only exception is if the amount of income you had from this crazy forking stuff that went on in 2017, if you didn't include it properly and your failure to include that properly resulted in what's called a material misstatement of income, which basically is like a 20% threshold, then the normal 3-year statute of limitations becomes a 6-year statute of limitations. So in that case, the statute of limitations is open to either April or October 2024 instead of April or October 2021. So just something I thought that's worth mentioning. If you held Bitcoin back in 2017 and you don't feel confident that you handled it correctly, talk to your tax advisor, determine whether your statute of limitations is expired or not expired. If it's not, determine whether or not, that maybe you should, file an amended return in that case. Again, regardless of whether you held on Coinbase or not, you would have had some level of income, due to the receipt of those forked coins. So you may want to check that out and look into it. One other point I just want to make is the date you filed your statute of limitations expire on the due date or the file date, whichever is later. So if you filed your return in February, that doesn't matter. The statute still doesn't expire until the relevant April. And if you filed an extension, it doesn't matter whether you filed even if you filed an extension, even if you filed your real taxes before April 15th, the statute of limitations still goes to October because you affirmatively extended your due date. So it actually, a lot of times, this is sort of a side thing to mention here, but people sometimes act like, why wouldn't you file an extension? Well, this is one reason. You're not only extending your due date by 6 months, you're extending the statute of limitations for audit by 6 months whenever you file an extension for your tax return. Now, if you missed the deadline, let's say you filed an extension, but you didn't file your actual taxes till November, then the statute expires in November, not the actual due date, because you didn't file it on time. So side diversion there, but something that may be useful if we're getting close to tax time and you're trying to decide whether or not you want to file an extension.
Yeah, no, that's really interesting. And to move on to the next section, obviously there are smart ways to go about your taxes in terms of trying to limit your tax liability. And with Bitcoin, if Bitcoin continues to do what it has been doing and what we all expect it continue to do, that can make a big difference. And so, at Unchained Capital, we're really excited about the idea of Bitcoin within IRAs. And I think that's a great transition to our next section.
Yeah, so holding Bitcoin in an IRA, the nice part about it is it makes all Bitcoin transactions totally non-taxable. You don't have to worry about even tracking your tax basis using any kind of software because your tax basis and your Bitcoin isn't relevant with when it comes to Bitcoin held within your IRA. If the IRA is a Roth, not only that, but the assets are free of tax whenever, even if you pull them out to spend them in retirement. An Unchained IRA allows you to hold in an IRA while holding your own keys, but still, complying with what are called the custodial requirements imposed by the McNulty case. And if we don't have time really to go into that today, but if you're interested in that, you can listen to our McNulty webinar, which will be linked in there, that really does a deep dive on that. You can also do tax-free rollovers into an Unchained IRA from existing retirement plans. And Connor is the leader of the let's say the IRA department on our client solutions team. So should you decide to sign up for an Unchained IRA, Connor will be your guy. So I'll let him take it for a minute in case he's got anything he wants to mention there about the Unchained IRA process.
Yeah, absolutely. Thank you, Jeff. And, to be mindful of time, we have so many questions in this question box. I definitely want to try and get to all of them. So I'll make a plug once again for our Unchained IRA webinar that is living on our YouTube channel currently. I'll make a plug for the webinar that we will be hosting in 2 weeks that will focus on answering as many questions as we can in regards to the Unchained IRA. And certainly, if you are interested in learning more, you can visit our website, and we have an entire page dedicated to the Unchained IRA where you can start your order or just set up time to speak with someone from our team to learn more about the product. But ultimately, what the Unchained IRA allows you to do is hold real Bitcoin in an IRA account that you control the private keys to. You can set up a traditional Roth or SEP IRA at Unchained Capital and roll over funds from a traditional, a Fidelity or a Charles Schwab IRA. You can also roll over from a 401k from a former employee, and we will walk you through the process of rolling those over as US dollars, converting it into Bitcoin, and importantly, setting up a custody solution through the Unchained Capital platform where we teach you and help you hold your own private keys, but also create a structure called collaborative custody, where we actually help in the responsibility of holding your keys. So in short, we don't really have time to jump into it fully on our conversation today, but what we do is we set up a 2 of 3 multi-signature address. You hold 2 keys and we hold 1, and you need any 2 of those 3 private keys in order to actually access that Bitcoin. Since we only have 1 private key, we don't have any ability to actually access your Bitcoin or prevent you from accessing your Bitcoin. But in a doomsday scenario, if you ever lost one of your private keys, Unchained Capital could actually help you recover your Bitcoin and get back to good standing again. And so that is a structure that we can set up for all of your Bitcoin related needs, whether it's personal Bitcoin, IRA Bitcoin, business Bitcoin, or otherwise. But ultimately, the Unchained IRA allows you to do that specifically within a 2 of 3 multi-sig context in collaborative custody. So there's some links on the page right here. We'll include them in the notes as well. And certainly feel free to set up time with our team if you're interested in learning more. Now with that, we can jump right into the Q&A section here. There are tons of questions in the chat, and I'll certainly do my best to get into as many as I can. We'll start one here with, Margie had asked the question, what is the tax basis of inherited Bitcoin?
Fair market value on the date of death, typically, of the person from whom you've inherited it from. The only exception to that would be if the estate, the person that you received it from, if it were a taxable estate, meaning an estate that had to file an estate tax return, and the estate elected what's called the alternative valuation date, then your basis is the value on the alternative valuation date. That doesn't happen all that much. If it did happen, you would receive a special form from the estate telling you that that was the case.
Excellent. There's another question. I can't find it in the chat here, but it looks like it's popped up a couple of times. What if you were buying, what if you're based out of the United States, but you spend a lot of time in Canada or Mexico or another country, and you technically buy Bitcoin while in that country?
Yeah, none of that matters. The U.S. Has a global system of taxation. So everything you do anywhere in the world is in America for tax purposes. That is always the case. So that assumes that you are what's called a United States person under the tax code. So a United States person, anybody that's a U.S. citizen is automatically a United States person. Anyone that is a permanent resident or otherwise has a green card is automatically a United States person. Some people that do not have green cards are United States persons in certain circumstances, depending on how much time they spend here. If you fit in any of those categories, then it doesn't matter what country you're in. You may as well be in America.
Sure. I had mentioned at Unchained Capital, we help you store your personal Bitcoin, IRA Bitcoin, Bitcoin on behalf of a business or a trust. Our first product and one of our main focuses is Bitcoin-backed loans, allowing you to put your Bitcoin up as collateral, take US dollars out on it, not have to sell, and ultimately be able to extract utility from your Bitcoin without having to sell, which is why we always say here at Unchained Capital, friends don't let friends sell Bitcoin. So there was a really good question in regards to taking out a loan against your Bitcoin. I'll throw that on the screen here. If Bitcoin is considered property and take out a loan against my Bitcoin, are interest payments on the loan a tax deduction?
Well, I mean, it depends on, it's like any other loan. It depends on the use of the funds, right? So if you take out a loan and you use those funds to make an investment, then you may qualify for the investment interest deduction. If you take out a loan and you use those funds for a business expense, then the interest payments may be a business expense. If you use them for personal purposes, just like any personal interest payments, you're not going to get a tax deduction for them. Some people are used to deducting interest they pay on a mortgage. A mortgage is a very special exception to the fact that interest payments on personal loans are typically non-deductible. I'm talking about a mortgage on a personal residence here. And that exception requires you to give a lien on your house to secure the loan, which obviously is not the case in a Bitcoin-backed loan. So that wouldn't qualify. But like I said, if you use them for business purposes, it's a business expense. If you use the proceeds for investment purposes, it may qualify for investment interest expense. And of course, talk to your tax advisor about it.
Perfect. All right, rolling right along. Virgil asks this question: does spending or transferring Bitcoin affect my tax basis? And it sounds like from the question they're asking about how fees are treated within that kind of tax equation.
Oh, so I'm going to assume what he means is like a commission on purchasing Bitcoin or on a sale.
Yeah, I was thinking that, or potentially like the transaction fees from the Bitcoin network.
Yeah, so that all gets added to your basis.
A question from John. John here said, if my keys are stored on 2 treasures and each are assigned to my 2 children, how can it be a taxable event?
Yeah. Can you read that one for me again, Connor?
Yeah, if my keys are stored on 2 treasures, I think the idea is if I have Bitcoin and I guess the important quote here is assigned to my 2 children, how can it be a taxable event? I guess a question within this is, can you assign hardware devices to other individuals?
Yeah, I mean, sure. If it's that's a bona fide gift, right? Which is typically not a taxable event unless you're going over the annual gift tax threshold, as we discussed. So if you give them the treasures and they have the pin or the seed or whatever they need to access the coins, and you give up control over those to their kids, then that is a bona fide gift. So whether or not that's a taxable event depends on whether or not you go over that $16,000 gift tax threshold. If the kids are underage, and you want to give them a gift, then usually you would have to do that through a trust, right? Because kids can't necessarily exercise dominion and control over property in that way. And then in that case, it's based upon whether or not the trustee, has gained dominion and control over the whatever's relevant in order to move the coins. So the seed or the pin to the treasure or physical possession of the treasure, whatever the case may be.
Got it. One of the benefits of Bitcoin is it allows you freedom of movement to live where you want to live with your money. One of the questions we have here is, what impact does moving to or leaving the U.S. Have on taxation of your Bitcoin holdings? Deemed disposition on leaving, tax basis at the time of entry. Maybe you can just give a little bit more clarity on, if you move from a country, how that's treated, or move from the U.S. per se.
It's not relevant to anything unless you actually formally renounce your citizenship, which is, I'm not giving you legal advice here. That's typically not a good idea. But it is a thing you can do. You can renounce your citizenship, or if you're a green card holder, you can renounce that as well. There's no guarantee you can ever get that back if you want to come back. But if you do that, there is something called an exit tax upon renunciation that potentially may affect you depending on the amount of your assets. And that's not a Bitcoin specific thing. That's much more related to Bitcoin is like any other asset for that purpose. That is a very, very complicated tax situation, and I recommend you meet with a tax attorney who specializes in expatriate tax issues. That is not something that I ever really worked on when I was in private practice. If you're looking to move to not pay taxes on your Bitcoin, expatriation is not even like the smartest way to do it. Moving to Puerto Rico is because Puerto Rico has, and again, if you're considering this, you have to meet with a Puerto Rican attorney because there are very specific requirements you have to meet. But if you move from the mainland to Puerto Rico, become a bona fide resident, spend 6 months a year there, you basically get out of almost all taxes on capital gains on your Bitcoin, at least with respect to capital gains that accrue after you've taken up bona fide residency in Puerto Rico. The other advantage to that is you don't have to give up your citizenship, right? Because Puerto Rico, as most people are aware, is part of the United States. But again, if that's something you're considering doing, please talk to a Puerto Rican attorney.
Great, thank you. Looks like we have time for maybe one more question, if you can answer it quickly, because it did pop up a little bit. We talked about being, the tax basis is marked on that day. What price is that marked at, given the fact that there's a 24-hour period there where it could fluctuate?
Yeah, and well, not only that, right? There's different exchanges that it's trading on at differing prices, right? So it just has to be any reasonable method consistently applied. So you can't constantly be changing methods to do whatever's most beneficial to you. You have to use some consistency, and it has to be reasonable. Examples of a reasonable method consistently applied would be using the Yahoo Finance quote for that day. We'll have or Google Finance does it too. We'll have a high and a low. You could take the average of the high and a low. That would be a reasonable method, completely consistently applied. CoinDesk puts out an official Bitcoin index price daily. You could use that. That would be a reasonable method. You could take a large exchange like Coinbase or Kraken, look at the trading prices on that day and take some sort of an average for the day. Those would all be examples of reasonable methods consistently applied. That you could do those. And that's not meant to be an exclusive list of ways of bites you could take at that apple, but those are all ones that are probably going to qualify as reasonable methods.
Yeah, excellent. Well, Jeff, thank you so much for your time today and your insights. As I promised you all, this was a riveting discussion. I think we probably could have gone for another 30 minutes or 60 minutes with all these questions in the chat. Really appreciate everyone joining. As a reminder, this has been recorded and a replay will be available on our YouTube channel within the week. Additionally, if you have more questions about the Unchained IRA or Unchained Capital, absolutely go to our website. There's also a link popping up on the screen here where you can set up time to speak with a member of our team to learn about private keys, 2 of 3 multi-sig. And if you're interested in learning specifically about how to take advantage of some of these tax advantages within a Bitcoin IRA at Unchained Capital, certainly feel free to set up time on my calendar. If you happen to miss any part of the session today, feel free to stick around and there will actually be a replay available shortly on this same link. Thank you all so much for the time. Jeff, thank you for joining us, and we'll see you again next month.
Thanks, guys.